Government needs to borrow money to do some of its programs, and it does so by selling bonds to the private sector. Investors are quite happy to buy government bonds because they bring a guaranteed rate of return. But a government can be seen as a possible defaulter when its investment grade is downgraded. Ratings agencies downgraded South Africa's sovereign, foreign and local currency ratings to sub-investment grade last week.
Whether we like it or not, their pronouncements have an impact on how foreigners view the market and on how foreigners allocate their flows to emerging markets. They also determine South Africa's weighting in some of the offshore and foreign bond indices, where you do then attract some capital to the bonds by virtue of the fact that you're in particular indices. So as the downgrades come through and as our credit quality gets weaker, so our weighting in the indices comes down, and even in some dramatic cases we could fall out of indices totally.
And those signs are starting to show. JP Morgan has removed South Africa from its investment grade emerging market bond index starting in late April. Roughly $49 billion worth of South African bonds are benchmarked against JP Morgan's investment grade only emerging market bond, while $10 billion of debt is linked to its global bond index. The move is expected to cause outflows of money of between $1.5 to $2.5 billion.
With that uncertainty prevailing, as an investor in bonds and in fixed income, we would still be a little bit cautious because the outlook is so uncertain. Keeping client portfolios underweight or underexposed to duration in an attempt to protect clients' capital if this does go, a lot worse.
But Wood believes bonds are still a great investment despite the economic turmoil currently happening in the local market. Consumers can access these through Treasury's retail savings bonds sold over the counter at retail stores and post offices, or through unit trusts and funds. Johannesburg.